Good morning, everyone. Thank you for joining today's webinar. Sorry for the wait. Thank you for your patience. And thank you again for joining us in this lovely morning. This is Nick, Managing Partner of Altive. Today is basically the first webinar of Altive in this years. And today we are talking about a very interesting topic. We have invited Shawn, Lese, Head of Portfolio Management from Nuveen, to talk about 5 disruptive themes for global real estate in 2021. And we also have a very interesting panel. We have invited Ray Tam, Managing Partner and Co-founder of Raffles Family Offices, Jim Kwok, CEO and Co-founder of Topaz Capital, and also Henry Chui, Head of Private Wealth from Nuveen, Asia Pacific, to discuss about alternative investment trends in Asia from a family office perspective. So I hope this morning will be a very interesting morning for all of you. And we will start the presentation to talk about some of the trends that we see in the private market alternative investment space. Yes, for some of you who doesn't know Altive before, just a quick introduction. Altive is an alternative investment platform backed by Pacific Century Group. Our goal is to bring investment opportunity that were only available to institutional investors before for more investors. And to start the presentation, I will talk about what is alternative investment, because this topic is getting a lot more attention these days. Thanks to the IPO market, a lot of investors trying to get hot IPO like Kwok, like JD Health, but they can't get allocation. And then investors start to think, how can they get allocation? How can they invest in those companies in earlier stages? And that is pre-IPO investment in terms of private equity. And a lot of investors is asking us on this topic. And therefore, we try to put together this webinar to address some of the issues that our clients have. And the first questions is really to define what is alternative investment. In a broad sense, alternative investment is basically everything outside of your traditional equity, bond, and cash. And from a more narrow sense, if we look at it from an institutional investor perspective, they usually focus on a few areas: hedge fund, private equity, real asset, and also private credit. And in terms of private equity, there are different subsectors. You will have your growth capital focused on late stage tech company. You will have your leverage buyout focusing on more mature companies. Some of them are even in the public market, and they wanted to privatize those companies and also do some operational enhancement and sell it to other investors. That's your leverage buyout. And also there is another kind of private equity called venture capital, focusing on really early stage startup. This is private equity. And you have your real asset. In terms of real estate, of course, you have your real estate, which would have commercial real estate, residential real estate, and of course, sectors getting much more popularity these days is industrial real estate, which is your data centers, your logistics centers. And of course, you will have your infrastructure. That's your transportation, like toll roads, like airport, and also utilities and telecom infrastructure. And that is infrastructure investment. And also you will have natural resources like commodities, like energy, and also like farmland. That's natural resources in terms of real asset investment. And lastly, I think that last bucket I want to talk about is private credit, which is an asset class that are getting a lot more attention these days. Thanks to the regulation changes, we are seeing, 20 years ago, we are seeing this asset class to grow in the US, and then 10 years ago, we are seeing this asset class to grow in Europe, and right now, we are also seeing this asset class to grow in Asia. And in terms of private credit, there are different sectors as well. You will have your direct lending, basically lending to mid-market companies, private companies, and then you will have your structured finance, that's your ABS, MBS, and then you have your specialty finance, which could be aircraft financing, which could be receivable financing, that sort of financing. And then lastly, I think that is a topic that a lot of our investors would be interested in, is distressed credit. They want to take the advantage of this market scenario and provide financing to companies that might be in a difficult situation. That's distressed credit. And that basically the broad sense of these three buckets are basically the broad sense of alternative investment from an institutional investor standpoint. And of course, when we talk about alternative investments, a lot of our clients would ask, is it always to be illiquid? Is it always to be locking up for a long period of time? Traditionally, yes. For the traditional PE fund, usually you would have 8 to 10 years lockup. You sacrifice some of your liquidity and get premium, and that's what they call illiquidity premium. And nowadays, I think the market have been changing. So there are different types of alternatives that could provide more liquidity for their client. There are private REITs in the market right now that are able to provide investors monthly liquidity for their private real estate investment. And also there are hedge funds that of course could provide monthly or weekly liquidity for their investors. And those bucket is what we call liquid alternative. And from an institutional investor standpoint, what are the main drivers for them to allocate into alternative investment? We are seeing a lot of attention from institutional investors on this bucket. And the most famous example is the Harvard Endowment. They actually allocated almost over 50% of the portfolio into alternative investment. And the main reasons are basically steady performance, because alternative investment usually have low correlation with other asset classes, with your traditional bonds, equities, and cash. This is the first reason. And secondly is the risk that you have. Usually the alternative investment you choose might have idiosyncratic risk that are basically different source from your traditional investment. Say we are looking at a life settlement product right now, and the risk for that product is basically the longevity risk of the policy holders of those insurance policy. And that risk is basically very uncorrelated with the public market. And lastly is your product exclusivity. In terms of alternative investment, you have the chance to access to opportunity that you can really access in the public market space. And this is, I guess, a very good illustration. Back then in the days, you have Baidu, you have Tencent. They basically listed within just 5 years, and you can buy it in a very, very early stage. But if we look at the hot startup right now, you have ByteDance, you have Grab, you have Didi, and of course you have SpaceX. They all have a very sizable valuation right now, all over basically almost 100 billion valuation, but they are still staying private. So for investor wanted to invest in this high growth company, you really need to assess it from a private market standpoint. If you investing it in a public market, wait until they list it, they might be already too big. You might lose a lot of potential after if you investing after they list. And of course, we see family office are very interested in these sectors. According to a research from UBS, 77% of family offices already invest in private equity products. And 52% of family offices invest in private equity product to diversify their exposure. But there are a lot of challenges that they have investing in this kind of private equity deals. One of the challenges is due diligence, because most of the family offices don't have a very sizable team focusing on private investment. But in terms of private investment, this is much more complex compared to your public market, your equity investment. You will have a team of lawyers to look at the deal document. You will have to do some due diligence on the company's financials because those are not public. And that sort of due diligence that you have required significant expertise. And second challenge the family office would have is the deal flow. Because from a private market, from a private company standpoint, from a startup standpoint, if I wanted to tap into capital, the first time basically the first audience I would tap is those private equity funds or strategic investors, because usually they could write a sizable ticket size for them. And very often for this kind of good company, it's very rare to directly talk to the family offices unless they have really good connection. So lack of interesting deal flows is also another challenge that we see from a family office standpoint. And the third, I think, is the investment size. For this kind of private deals investment, usually they would come in a big block. Usually the block size would be around 30 million to almost 100 million US dollar. And for family office investing into this kind of deals, not that they don't have that much of capital, but they don't want to put too much of capital into one basket. And therefore, this kind of size limit is prohibiting them to investing more in private equity space. And these are the challenge that I think our clients are having right now. And if we look at the global family office standpoints, I think they already quite a good number of mature family offices or private wealth individuals are already allocating quite a big chunk of the investment into alternative investment space. You have 16% in private equity, 14% in real estate, and then almost 10% in some other stuff. But if we look at Asia family office, I think we all know as Asian investors, we all like real estate. So most of them would have sizable investment in real estate, but also they are usually they would underinvest into private equity and other alternative investment asset class. And even for real estate, most of them will be focusing on the region that they are familiar. Say the region that they like for Asian investors, usually their investment will be in Hong Kong, in China, or some of them, I think UK is an option that are getting more popularity, but usually they don't really have a diversified portfolio in terms of investment and also in terms of the sectors that they pick. Usually that would become limited to commercials and residential. But real estate investment, there are still a lot of subsectors that you could pick. Like what I mentioned, the industrial type of real estate, the data centers, the logistics centers, that require lots of expertise to invest in those asset classes. And those will be quite interesting for family offices. The numbers on the right-hand side is the numbers for 2019. And of course, for 2020, you will have quite a different set of numbers. I think it would be a very tough environment in Q1 and for the public equity investment. But of course, in Q2 to Q4, basically the performance of public market is very, very strong. So most of the clients that we see, they actually have quite a strong performance in 2020. But if we look at it in a longer horizon, I think the numbers that we see, private equity still give investors a higher than average return in terms of their portfolio. In terms of deal investment, usually they generate around 16%. In terms of fund-based investing, they usually generate about 11% for their portfolio. And of course, you will have your real estate investment, and that usually generates about 10% in their portfolio. And right now at this stage, we are seeing clients trying to take profit from their private market investment and trying to invest in some of the asset class that seems to be left behind. And real estate is one of the asset class that I think we are seeing quite a lot of interest in these sectors right now. Especially we are seeing central banks from all over the world is printing money, and they think, our clients think quite a lot of capital would be allocating to this kind of real asset investment. And lastly, I would like to talk about some of the trends that we see for 2021 that would be interesting for our client. I will start with income generating real estate. I think that is the asset class I just mentioned. Our clients are trying to allocate into these sectors because central banks worldwide are printing money. And of course, they wanted to focus on a particular area, core corporate real estate, to replace some of their bond investment because the interest rate is so low. They still need assets to generate income. So income generating real estate, core corporate real estate is a safe option for their portfolio to generate income, but on the other hand, could provide capital appreciation potential. This is one of the themes that we see could be interesting for our investors to look at. And the other themes that we think would be quite interesting is logistics sectors in China. Thanks for COVID, it basically expedited the trend of e-commerce. And because of e-commerce, there's lots of logistic needs, logistic demand in the country. And what we see is especially truck, basically digital truck matching platform is quite interesting. You will have your food truck alliance in China, basically Uber for truck in China, that's getting a lot of popularity because of the COVID. And then you will have Lala Move, of course, that also driving the demand of logistics. So this is one trend that we think investors will look at. And the other trend we think could be quite interesting is autonomous driving. In terms of autonomous driving, you would have your Tesla, you would have your NIO in the public market space. But if you wanted to tap into that supply chain, there is still a lot of company in that supply chain is actually still in the private market. And that I think worth investors to look at. Say your basically the chips providing the autonomous driving system, your LiDAR, your basically the radar, in terms of sensing the driving environment. Those companies are still, a lot of companies in that supply chain are still in the private market. And I think those areas would be still very interesting for investors to look at. And lastly, I would like to talk about SPAC. SPAC is a very interesting breed of investment because it is listed in the public market, but I would say it is quite uncorrelated with your traditional equity investment, because in a certain sense, it's almost like a private equity investment. You are investing in a team of the SPAC to help you to pick a good company, good private company, and take it to private. So their behavior, their performance is actually quite different from your traditional private equity investment. And for SPAC, I think 71% of money raised in IPO will be still coming from SPAC in these years. And there will be more and more SPAC coming to the market to take private company into the public space. And this, I think, is also one of the trends that investors should look at. So let me see if there is any questions. So if there is no questions, we will pass the time to Shawn Lese to talk about 5 disruptive investment trends in terms of real estate investment. I think this could be quite interesting because a lot of our client is asking in this COVID scenario, a lot of people are still working from home. Should they still invest in commercial real estate? So I will pass the time to Shawn to talk about the trends that they see in private real estate investment. Thank you.
Hi, can you see me? Just trying to see if I'm visible and making sure you can hear me before I start.
Yes, Shawn, we can see you. You can start now. Thank you.
All right, terrific. That's great. Well, thank you for putting the presentation up, and also it's reassuring to hear that there are so many people potentially interested in real estate. Obviously, we're big fans of real estate and think it's a great class to be investing in. But let me just start off. I'll start with some introductions. My name is Shawn Lese. I'm Nuveen Real Estate's head of portfolio management for the Americas, and it's a real pleasure to be able to speak with you today and share some perspectives on the outlook for real estate in 2021, and indeed some of those disruptive themes that I think are going to play out and make real estate an interesting place to be investing. But to begin, I'd also like to give you an introduction to our firm's parent. So Nuveen Real Estate is a wholly owned subsidiary of Nuveen. Nuveen is the asset management arm of TIAA. And Nuveen is a 100-year-old asset manager, right? In fact, we're the 17th largest asset manager in the world at Nuveen, the general asset manager. And we've got 1.1 trillion of AUM. Nuveen's investment activities are pretty wide. They span fixed income, equities, real assets, private capital, multi-asset solutions, and of course, real estate. So that's our parent. But next, let me turn to Nuveen Real Estate. So Nuveen Real Estate undertakes all of the private real estate investing activities for Nuveen. It is one of the world's oldest and largest real estate investors. We've been investing in real estate for over 80 years and have nearly $130 billion of real estate assets under management, right? We've got over 600 employees. We're located in 29 offices around the world, and those offices include 11 in the US, 12 in Europe, and 6 in Asia. And proud to say Asia is one of the places that we're definitely going to be looking to build out our presence more firmly, over the next upcoming years. And part of the reason why I mention our legacy and scale is because these are some very important facts, right? So our long experience in investing in and operating real estate, it's really taught us many lessons on how to generate consistent outperformance. And our scale is important as well, because that gives us the resources to invest in and build out the firm so that we can continue to outperform. And then finally, as part of this introduction, let me also touch on 3 principles that we follow to deliver outperformance. And these principles are, first of all, local footprint, thought leadership, and sector expertise. And I'm mentioning these now because I'll keep pointing to them as critical aspects of our operations that allow us to identify the themes that I'm going to be discussing later on. Right, so just I'll dive into each of those 3 just very quickly here. So first, I think everybody knows this, right? Real estate really is a local business, right? Thus, we're hyper-focused on having a local footprint, right? We believe the local players will always outperform. And this is because being local fosters strong relationships with sellers, with intermediaries, with tenants, and it provides this intimate market knowledge. And it's this kind of market knowledge and connectivity that's not really available to an investor who, for example, is kind of located in New York City and then wants to buy an asset in say, Dallas, Texas, right? It'll be a challenge. It'll be challenging for the New York City investor to have the same level of connections and knowledge that the local investor is going to have. And so this local investor is going to, typically have the upper hand. And then let's talk about thought leadership, right? So it's absolutely imperative that we've got cutting edge thought leadership. This is critical so that we have a roadmap to add value through applied research, sustainability, innovation, and consumer insights. And to do this, we look to our dedicated global strategic insights team. As I'll discuss a little later, they've been instrumental in developing the city selection process for our investments and help us select the real estate sectors that really have the best outlook for performance. Also, we have a very strong ESG team that weighs in heavily on all of our acquisitions from a sustainability perspective. And this team also develops asset management plans at our properties to ensure that we're integrating the most cutting edge ESG concepts. And then lastly, for this introduction section, sector expertise, right? We just talked about it a couple of seconds ago. Nick referenced that. This is absolutely critical, right? We need deep sector specialization. And we believe that the specialists will consistently outperform the generalists, right? So for example, someone who invests only in industrial properties is going to be able to deliver better performance than someone who's focused on offices in the morning, apartments in the afternoon, and maybe industrial only in the evening. And the reason is that, the participants in each of these sectors, the dynamics and the economic drivers in each of them, they're different. And specialization allows our teams to understand them the best, right? As a result, we've structured our execution team along sector lines. And this is unique in the industry because it's expensive to do. But our scale allows us to do so efficiently and frankly, with some pretty good results, right? So enough about the introductions and background. Let's get to the point of today's discussion, right? The disruptive themes. Is it possible to turn to page 2 of the presentation? Right, and so this is a very relevant topic for many investors due to the volatility the asset class experienced in 2020, right? 2020 was a pretty interesting ride. Real estate wasn't alone, but real estate was certainly there in terms of, what performed well and not. And, so real estate started 2020 very well, and it ended the year, I'm gonna call it kind of mixed, right? Some real estate is doing better than it was in 2019, and other real estate, is frankly kind of struggling to recover from the COVID lockdown lows, right? Nonetheless, if invested in correctly, right, we believe that the current market offers very attractive opportunities for allocations to private real estate. And if done correctly, part of my statement really gets to the heart of what we're going to talk about today, right? And that's digging into these 5 themes. And if we understand some of these themes, that can possibly help us to make the correct investments during the course of 2021. Right, so what are these themes? Right, these themes are listed here on page 2. As you can see, they are awash with cash. I think we already touched a little bit on quantitative easing. We'll touch a little bit more on that. Identifying winners and losers, sector rotation, 4th, rethinking urban centers and suburban life. And then lastly, climate change, right? So can we turn to page 3, please? Right, so I'm gonna start with awash with cash because this is something that is having a super powerful, immediate near-term effect on real estate. And what do I mean by awash with cash? Let me show you, if you turn to page 4. Thank you. The chart on page 4 shows the extent of quantitative easing actions that have been taken by governments around the world, right? I think we've listed out here the Fed, Bank of England, and the ECB, but we could easily pick a number of other countries' central banks and what they've been doing. And quantitative easing, or QE for short, right, as I'm sure you all know, is a form of non-standard monetary policy, right? A central bank will purchase longer-term securities from the open market in order to increase the money supply and to also encourage lending and investment, right? So buying these securities adds new money to the economy, and it also serves to lower interest rates by bidding up fixed income securities. So the bars on page 4 illustrate the extent of QE activity by these central banks. This is measured in terms of the QE actions as a percentage of the country's GDP. And as you can see, in 2020, central banks around the world really executed a massive QE exercise that dwarfed, all of the previous QE actions that have been taken, right? And so they're kind of reaching up to sort of 14% of GDP. That's a pretty big number, bigger than anything that we've seen in the past. And to kind of like put this in another context, or to state these actions in other words, the U.S.'s QE plan, which was launched in March of 2020, was over $700 billion, right? And then in June of 2020, so just kind of 3-4 months later, after a brief kind of tapering effort, right, the Fed extended this program, and they committed to buy at least 80 billion per month in treasuries and 40 billion in mortgage-backed securities, right? So just a massive QE assault, on the economy. And what does this do? Well, just as I kind of described above, right, it increases liquidity, it lowers interest rates, it increases the money supply, and then it all of that pushes people into investments that can provide some kind of a higher yield, right? And real estate's really one of the big beneficiaries of that. So we've really seen QE driving kind of. Could we turn to page 5? So the impact of QE feeds directly into the second theme that I'd like to discuss. And that's identifying winners and losers. And in the next page, we'll see how QE has contributed to making real estate in general, a pretty attractive asset class, right? So yeah, thanks for turning to page 6. That's great. So why is now a good time to invest in real estate? Well, in short, despite all that's transpired during 2020, real estate offers today's investors a stable, high income, as well as strong relative value. And let me explain a little bit about, why I say this. So the chart on the left-hand side of this page, page 6 that you see here, it shows the differences between the yields from long-term investment grade bonds, right? And that's the blue line that you can see there. And the capitalization rates from real estate, and that's the black line. I'll take a quick second to explain cap rates just to make sure we're all on the same page with that. But capitalization rates, also known as cap rates or net operating income yields, those are all kind of like names and terms used synonymously. But cap rates simply reflect the income yields that are provided by real estate, right? So kind of what is that? What is the income that comes off the real estate? And the formula for this yield is basically the net operating income from the properties, and then you divide that by the property's value. So for example, if an investor buys an office building that delivers operating income of 5 in a given year, and the value of the property is 100, the cap rate would be 5%, i.e. 5 divided by 100. So you can also think of a cap rate as the inverse of an EBITDA multiple. All right, but back to the left-hand chart there. As you can see, the spread between income yields from bonds and real estate are at historic highs, right? So that spread is really gapped out. Investors could invest in bonds and get an income yield of say 3.1%, or they could invest in real estate, which delivers 5.4%, right? That's a 2.3% difference, right? So real estate sounds compelling from an income perspective. But what about valuations, right? And this is answered on the right-hand chart. This chart shows the historic and current spreads between direct real estate cap rates and US Treasuries. And I'll explain why this is important. So when the spreads are wide, it signals that the real estate is cheap on a relative basis, right? So currently, spreads are quite wide. Over the past 15 years or so, spreads averaged 3.2%. As shown in the black horizontal line that you see there. Now, spreads are at 4.6%, right? Suggesting that real estate is attractively priced compared to other asset types, right? So that's why I conclude that now is a good time to invest in real estate in general, but it's not quite that simple, right? We're talking about disruption here, and nothing can be simple in that sort of environment. And it's not simple because of the K-shaped recovery that we're currently facing, right? This is something else that needs to be considered. And this is where we get into picking winners and losers, right? Could we turn to page 8? Thank you. Let's take a look at this page so I can demonstrate what I mean. This page is one of my favorites. It highlights two things. First, it shows the price performance of different real estate sectors. While now is a good time to invest in real estate in general, we have to focus on the individual real estate sectors, right? As we mentioned earlier, the drivers of performance for each sector, each of these drivers are different, right? So real estate is not just real estate as sort of this general amorphous term. Apartments are different than offices, and those perform differently than hotels, and retail is different than industrial, for example, right? In fact, recently, the two of those are practically at the opposite ends of each other in terms of performance and correlation. And also like healthcare related real estate is different than all of those and performs differently. But on the chart, right, each of the different colored lines represents a different real estate sector. Okay, so that's the first thing to think about on this page. The second thing is that the chart shows a comparison of real estate's performance during 2 recessions. So on one hand, we've got the global financial crisis from about a decade ago. That's the gray box on the left. And then we've got the COVID-induced recession of 2020. And that's the gray box on the right, right? And what this chart illustrates is that during the GFC, all real estate was negatively hit, right? It would have been kind of correct to say that, in fact, all real estate was just real estate, right? But that's different than the recession of 2020, when some sectors such as, industrial, medical office buildings, and apartments performed quite well, while others, such as indoor malls, hotels, and offices, have done rather poorly, right? And we feel that this performance dispersion is going to continue over the medium term, right? As the sectors continue to show their kind of like how they're going to, their diverse recovery trajectories, right? And so the message from this page is clear, right? Pick your exposure wisely, make sure you're overweight the winning sectors and underweight the losers, right? So which are which? Could we go to page 9? So this is just a pretty high level, simple kind of weather map type of a page. listing out, going from left to right, a couple of different primary sectors. The primary sectors we think of as, office, industrial, retail, multifamily. And then we've also kind of like taken a look and taken a stab at trying to think about these from a geographic perspective, and what's the outlook like in different countries around the world. And what's kind of unique about this point in time right now is that, generally speaking, you're not going to see the same outlook and trajectory for all asset classes in each of the countries, right? Generally, some countries will have, very good drivers and reasons why, say, one asset class will be performing well versus another sector, why that's not going to be performing well. Generally speaking, we're in kind of a point in this COVID world, and not surprising, where, in most of the countries, the good sectors are the good sectors and the bad sectors are the bad sectors. And so let's take a quick look at what some of those sectors are. First of all, let's talk about retail. First on the list, it's the probably the worst sector other than maybe hotels. But retail, you see a lot of clouds there. You might actually, we've only got 3 categories: negative, neutral, positive. We might have a super negative one in there with some lightning or something like that in there. But retail's been hit extremely bad. That started back in 2017, was sort of the first time the concept of the retail apocalypse, arose as a result of e-commerce. And COVID just accelerated that particular trend, right? So if you've got retail that's basically kind of discretionary, involves discretionary transactions, that's doing very poorly. And think about the poster child of that as being sort of enclosed malls, right? On the other hand, you have needs-based retail, such as grocery-anchored shopping centers, and those have actually been holding up and performing pretty well during the whole COVID period, right? So that's retail. A lot of clouds there. All right, move one to the right. You see industrial. A lot of sunshine here, right? What's going on with industrial? Well, e-commerce is first up. Massive demand. People are no longer going and buying their goods from a retail store, from a shop, right? What they're doing is they're just getting it sent to them. It's got to be stored somewhere. They're just getting sent from warehouses. There's extra demand for the warehouses. And then the other thing that happened during the COVID period is it really changed a lot of manufacturers and people who delivered and needed to store goods that were ordered by other people. It changed their supply chain philosophy from, say, what we call just in time to just in case. And so a lot of those warehouses that have been storing things that were delivered to people just so they could get there in time, they maybe increased their inventory by 5% or 10%. And this just translates directly into incremental demand for logistics and industrial space. And then we've got multifamily, right? So multifamily, generally speaking, has been doing very well, particularly things that are more suburban, more garden-based, meaning not very highly dense in terms of how tightly they pack people in, and the type of multifamily that's not luxury, right? So very expensive. So if you have a high-rise luxury office tower in New York City, you're going to be 25% vacant right now. Your offering rents are going to be 35% below what they used to be, and you're going to be in a bad position. If you own a 300-unit, 3-story suburban apartment complex in Austin, Texas, you're probably actually able to maintain your occupancy higher than it was pre-COVID. Maybe you're flat on rents, and maybe you can start pushing the rents up a little bit too, right? So residential multifamily have been doing pretty well. And then lastly, there's office, right? And so with office, the first thing that comes to mind is, hey, work from home. Are people ever going to go back to office? And I'm going to save this one for a little bit, just because we're going to dig into that one a little bit more in just a second, and kind of like think about that from more global perspective, because I think there's a different approach regionally that happens with office. But generally speaking, office has been hit. And again, to the extent that it's CBD office, it's sort of like multifamily. Nobody's going back, right? And currently, and if you're suburban office, on the other hand, people feel more comfortable going into the spaces, and there's more activity from a leasing perspective, right? So generally speaking, though, office, a lot of clouds, a lot of partly sunny there, not quite as much as retail, but certainly not up there with multifamily or logistics. So that's quick canter through a couple of different sectors. And, again, that's why I say, pick your sectors wisely, right? But all of this was sort of a static view of the world as it was, during COVID and as it is. But let's continue these thoughts into the context of a changing environment, right? So this is really where sector rotation comes into play. Could we go to page 10? Thank you. So the third theme that I want to discuss is sector rotation. And earlier I mentioned our belief in the importance of being sector specialists, right? This was not just so that we can see if a sector is doing well or poorly, right? You don't need a specialist to identify like if it's doing well or not. It's important because being a specialist really allows us to see the factors that identify why a sector is doing well or poorly, right? And knowing why it's performing as it is, in turn allows us to know whether we should be buying or selling that sector, right? And the performance of sectors continuously rotates. Industrial, clearly is favorable today. In 2013, you couldn't give it away, right? And so we need to be ahead of the rotation to maximize performance. And this has never been more true than what we're living through in a COVID world, which looks quite different than what it's going to be in a post-COVID world. So, you have a vaccine, you have inoculations, herd immunity, people are back and the world returns to normal. Things are going to switch again kind of pretty rapidly, right? So these changes happen quickly. Could we go to page 11? So what we've tried to do is just analogize real estate to an airplane that's flying through a cycle, right? At any point, it's going to be driven forward by tailwinds, but we'll also confront a number of headwinds that are going to kind of slow it down, right? And different headwinds and different tailwinds are always present, but they're constantly changing. And these are the things that we need to really keep our eyes open for and try to identify, as I mentioned earlier. So on this page, we've identified a number of the most, we think probably most relevant of the tailwinds and headwinds that are affecting real estate today, right? So for example, on the left-hand side of the page, we've identified some tailwinds that include things like, online shopping, or we talked about how that's helping out logistics, right? So these are things that are helpful. Technology and innovation are making real estate more efficient. Sustainability, we'll touch base on that a little bit as well, but sustainability is kind of part and parcel of non-obsolescence, right? Like if you've got a property that is a highly sustainable building, inevitably it's going to be an attractive building. It's going to be a building that we think is probably going to have longevity for the future, right? Impact investing is becoming very important for a lot of investors. And that's not just saying, hey, what am I making off this property? But is this property actually doing something for the community or for the world, right? We mentioned healthcare as well as a tailwind. So healthcare is being delivered around the world in different ways, right? There's becoming more of a decentralization of the delivery of healthcare. And this is providing opportunities for real estate. So it's a pretty big one. I'm also going to next mention the Sun Belt in the US, right? So a lot of migration from the Northeast, for example, down to places like Texas and North Carolina and Florida. And we'll talk about that. European suburban cities, right? So a little bit of suburbanization going on in Europe. And then the last one's really important too, right? So quality of life, right? If people don't feel comfortable in their environment, they're, particularly during this COVID period, just out of there, and they're leaving that environment. And they're going to someplace where they feel more comfortable. And then on the right-hand side of the page, right, we've identified some of the strongest headwinds against real estate, right? And so travel and tourism, anything that relies on travel and tourism, think hotels, retail again. Physical retail is the second thing we've got listed there, right? So, e-commerce is sort of the opposite of what's happening in retail. Anything that's hospitality related kind of relates back to travel and tourism. Densification, right? So there was a big trend toward co-living and co-working and just getting closer and closer together, right? COVID blew all that out of the water. That's all challenging. Work from home, again, we'll save that one for later. Public transport, to the extent that you need public transport to get into and access the real estate, that real estate's going to suffer, right? Big cities, urbanization, those are things that have got headwinds against them as well. And so, these are all driving the outlook for different types of real estate. These are trends that are pushing certain real estate to do better and some to do worse, right? And we've tried to categorize the performance expectation for different sectors on the bottom of the page. And interestingly, on the right are the real estate sectors that are being hit the hardest by these existing headwinds, right? And they're all what people generally refer to as the traditional real estate sectors, right? So retail, multifamily, office. Now, on the other hand, on the left, right, are the sectors that are benefiting from the tailwinds. And generally speaking, there are a lot of sectors that are considered to be non-traditional here, right? And these are designated as alternative or new sectors. And so what's interesting here to me is that at the present, we're really in a world that's favoring these new alternative sectors. Could we go to page 12? Yeah, thank you. On page 12, in the left-hand pie chart, we've broken out the total real estate pie by sectors, right? So that's if you think about what's a subsample of the universe of investable real estate, we've got it laid out there, right? Industrial sort of 52%, $52 billion worth in the US, 17% retail, 46 billion, 15% apartments, 22%, et cetera, right? But as you can see today, alternatives comprise a small part of the total, right? It's just 12%, and again, that's today. But we also think that these could represent something more like 50% in the next decade or so, right? So it's pretty important to keep your eyes on these sectors. And what are we talking about here? We're talking about things like, self-storage, senior housing, medical office buildings, hotels, parking, right? Other things, data centers. These are the types of things we're talking about here. And that 50%, right, that we're talking about, that's kind of represented on the right-hand side. And admittedly, we may be looking for some hyperbole here to get your attention on the right, but there's a very strong case to be made for investing in alternatives and staying away from things like malls, hotels, and traditional offices, right, until they really hit kind of rock bottom, and you can see that maybe they're just so cheap that they become something that's attractive to buy, right? But again, this all comes back to pick your sectors wisely, right? So let's skip page 13. If we could go to page 14. So this is our fourth theme here, rethinking urban centers and suburban life. So up until now, I know that I've kind of come across as preaching that investing in real estate was all about sectors. And while this is true, it's also important to focus on the more common phrase that everybody knows, I'm sure, which is location, location, location. And so now I'd like to talk about sort of our fourth theme, rethinking our urban centers and suburban life, right? The advent of the COVID pandemic really turned a trend on its head, right? And pre-COVID, urbanization was, an indelible trend, right? Well, COVID lessened the attractiveness of living in a dense environment, right? Especially when all of the restaurants, bars, cultural hotspots, and mass transit was shut down, right? Instead, more space and freedom kind of became a priority for users of real estate. Could we go to page 15? So this page shows, the truth of that statement. And what this page shows is the decrease in footfall at cafes, restaurants, and leisure venues in different cities around the world during 2020, right? The upshot is that, the fall off was highest in the dense urban centers such as London, Paris, and Tokyo compared to the rest of those countries, right? And so, for example, while footfall in London was only 20% in October compared to the beginning of the year, right? So it started at 100%, as of October, it was only at 20% in London, right? That's the green line on the far left. Activity in the rest of the country was, it had only fallen a little bit, right? So it was basically up at about 80% of the pre-COVID levels, right? And that's the black line that you can see on the left. So people in non-urban areas are active in just frankly getting on with life. And we know that with the vaccine, activity in urban environments could clearly bounce back quickly once everybody's inoculated. But in the meanwhile, suburban investments have gotten a boost in the arm, right, so to speak. And the pandemic has really put kind of a halt on pure urbanization as a thesis and really requires us to monitor people's behavior more closely, right? You know, when are people going to return to the cities, right? And should we keep an eye on the suburbs and, you know, no longer just automatically write those off as something that you know, don't really have much of a future, right? So next, let's turn to page 16. So page 16 really kind of gets to some of this whole work from home debate. And this is something that, you know, I think the first thing I would say is when people think about real estate, their mind always goes to work from home, and they kind of extrapolate, hey, I'm working in my office, you know, maybe it's working out okay, maybe it's not. But the thing that I just encourage everybody to think about is, you know, again, work from home really impacts one type of real estate, and that's offices. You know, as I've been talking about before, there are probably another 20 different types of real estate that one should be thinking about. So the first thing I'd say is, we're thinking about work from home. Don't necessarily equate work from home with, you know, all real estate in general. It really just impacts kind of that office using space. But what I would say about it is, you know, I'd like to think about it from three regions, because I think that the future of office in each of these regions is going to be a little bit different. So the first thing is, you know, when we think about Asia, there's, you know, when I look at kind of the office using population today, right, it seems like China's back to something like 90% of the people are back in the office. From what I've heard, Korea, it's sort of 75%. Singapore, it's 50, right? They're taking a little bit more of a cautious approach here, but it's still 50%. You go to New York City, and the office using population is basically at about 10 to 15% right now, right? So, you know, I think that it's pretty clear, once we get a vaccine, we get inoculated, there's definitely going to be a return to the office, you know, in Asia, right? In the United States, I'm absolutely convinced, you know, once we get that vaccine, we get inoculated, we get herd immunity, the leaders of most of the major corporations in the country have already come out and said, no, we need to have offices. This work from home thing doesn't work. You know, professional development is stopped. Generally speaking, corporate culture is slowly dissolving, right? It's sort of like you got the company here, and there's like the thin strand holding people connected to the culture, and that's just getting wider and wider, and soon that's just going to snap. There's no creative, I think Jamie Dimon called it creative combustion, right? Efficiency is just lost. And in particular, it's really hard when you've got new people that are starting to bring them in, to train them, younger people, right? So I really feel firmly that people are going to get back to the office in the US as soon as there's a vaccine, and as soon as you know, the employees feel comfortable to go back, and very importantly, as soon as the companies feel like they're not going to get sued once they bring employees back in, right? So that's the US side of things. I think Europe could be a little bit different, right? So what we've laid out on this page is we kind of feel like that the longer the commute time to the cities and from where people live, and depending upon the age of the workforce, right, there could be a higher or lower trend toward returning to the office or not. And so we think some places like, you know, London or Paris in the upper left-hand corner that generally have a really long commute time, right? It could be 2 hours that people commute, and have a, you know, generally a pretty young population. I think there's a higher probability that there's more office work that's going to happen. On the other hand, right, you go to the lower right, you get places like Dusseldorf, Milan, Lisbon, older population, very kind of, you know, conservative, and you know, frankly, not a long commute time. They're definitely going to be heading back to the office. So a little overview on the whole work from home question. Why don't we go to, I'm gonna jump, I'm just looking at the time here. Why don't we turn off the presentation now? And I'm just going to talk a little bit about climate change as sort of the last topic, right? I'm going to assume that we all believe that climate change is real, or at least that we recognize that weather patterns are definitely getting increasingly volatile, right? I tend to believe this. You know, in fact, over the last 48 hours, we here in New York have been hit by what we call it's basically been a top 10 winter storm that dumped nearly 2 feet of snow, and frankly, it's still snowing outside. But for investors in real estate, climate change has at least, you know, 2 things to think about. First, will climate change and more irregular weather patterns, you know, affect the property that we're buying? Climate could impact the properties in a number of ways, right? So if you own an office building in Lower Manhattan or downtown Miami, you know, a more frequent occurrence of floods may make your property unrentable, or even if people are willing to rent it, values are seriously going to be hit, or even liquidity. Somebody may not buy it for you. You may have a tenant in there, but they're saying, I'm not going to buy it because, you know, it gets flooded too often. I just don't want to own that, right? If you own apartments in an increasing drought-prone part of Southern California, right? How long will it be before your complex is in the path of, you know, the increasing wildfires that you see out there? You know, or what about an industrial property in the path of tornadoes or hurricanes in Texas, right? I think you get my point. I know what you're all thinking, right? You're all thinking, hey, but that's why insurance exists. And that's true. But when your insurance premiums rise by 30% per year, which they're starting to do, right, to cover these more frequent events, you're likely going to need to start paying attention to the environmental changes and make sure that you're buying property that's not in the path of, you know, incremental damage from climate change, because it's either going to get damaged or it's going to become really expensive to insure it. So we do this, and you know, it's a very significant part of what we focus on when we buy properties. And that having been said, you know, we do try to balance this, the risks that I just mentioned, right? But also considering the ways to mitigate those risks. So for example, you know, if we think of the example I mentioned earlier with the office building in Lower Manhattan, you know, we've got the technology and the wherewithal to build seawalls that can protect, you know, the tip of Manhattan and the buildings in that lower part of the city. You know, on the other hand, it's pretty hard to protect all of Miami, right? If the water levels rise, and even if you could build some kind of a seawall, right? Miami's built on porous ground, and if the water levels rise, the water's just going to come up through that ground because it's not solid granite bedrock like the tip of Manhattan is, right? So anyway, that's the first thing to think about with respect to climate change. Definitely need to pay attention to that. The second thing to think about is, I'll sum it up by saying net zero carbon, right? Right. So the appearance of climate change is definitely forcing people to think about, you know, what they can do to combat it, right? And the Paris Accord is a manifestation of the desire to control greenhouse gas emissions, right? And the reductions set forth, you know, in this accord, really are objectives that people, that companies, that governments are committed to achieving, right? And buildings, by the way, are going to be kind of front and center on all of that because they're responsible for something like 40% of carbon emissions, right? So, you know, they're going to be focused on by governments, right? They're going to be looked at by investors and by the tenants. And there's going to be a need to kind of hit net zero carbon for these, right? Not necessarily tomorrow, but, you know, some people are going to have goals for 2030. Some are going to have them for 2040. Others are going to have by 2050. But it's here and it's happening. And that time passes quickly. And if you buy property that isn't able to be converted or to be able to achieve that kind of efficiency, you're at a real risk of obsolescence, right? So, all right, so those are the five kind of disruptive factors I wanted to talk about today. And just I'll leave you some final words, right? I hope that you agree that now is a very good time to invest in real estate. But if you're doing it, you got to be very thoughtful about what you're investing in, right? Obviously, and you also need to continuously think about the different drivers of performance in each of the sectors and how they're changing and how that's going to affect the value of real estate. And then lastly, I'd just say, you know, make sure you think about the locations you're investing in and the risks presented by climate change, which are quite real. Thank you.
Thank you, Shawn. Thank you for your sharing. There is one questions from our audience. So what do you think about Asian invest in real estate compared to Westerners? What do you think about the Asian real estate market these days? Because you talk about location is very important. So how do you compare Asian and Western real estate market right now?
Yeah, what I've seen is the Asians are becoming quite aggressive, right? So they're intrepid. They're following a lot of the trends that we're seeing here now. So when we're looking at a lot of the alternatives, you know, a lot of the conversations that we're having are with investors, in particular, Japanese investors, Korean investors, and investors from Hong Kong. And it's you know, largely the big insurance companies, kind of sovereign wealth funds, and we haven't had a lot of dialogue with kind of the family office in the family office space. But they're active and they're actively looking at some interesting places, right? More so than, you know, frankly, I think some of the European investors are doing right now. I think it's also safe to say that, you know, I think a little bit earlier, Nick had mentioned that, you know, it felt like some family offices were probably, you know, kind of like focused on their local regions, and then also in London. And that's absolutely still very true, right, from a family office perspective. But from a, you know, larger institutional investor perspective, they're reaching out. I'd also say that they're probably more interested in the core side than on things that are kind of higher risk and more value add or opportunistic types of transactions. And that's an interesting perspective too, because, you know, right now, some types of real estate is getting expensive, right? Industrial is expensive. We've got to keep revising in our heads, what's an acceptable return for industrial? What's an acceptable cap rate for industrial? Same thing in the multifamily side, right? And that's a lot of money keeps trying to move into that space. And the only thing I'd be, and it core industrial, right? So if you need to play in industrial, it's probably a little bit better maybe right now to play in the value add or up the risk spectrum, because you can pretty easily build an industrial property in 6 months and you can get it leased up, and then you get a nice you know, warehouse, a nice industrial property. And so I'd probably say, think about, you know, from a risk perspective, whether core or industrial is, core or more value add is the place to be doing it. And do consider the value add side, because I think that there might actually be a little bit better kind of risk adjusted return in that space right now. Any other questions I can answer?
Thank you. So we thank you, Shawn, for his sharing. And right now we have a very interesting session. Today we have Sam from Raffles Family Office, also managing partners and co-founders of Raffles Family Offices. And then we have Kwok, CEO and co-founder of Topaz Capital. And then we have Chui, head of Asia Pacific Private Wealth for Nuveen Investments. And today we are going to talk about how family offices look at alternative investment, real estate investment in different perspectives. So the first question we have is, how do your clients look at alternative investment right now, especially real estate? Maybe Henry, can you share a little bit about your first?
Yep, absolutely. And thanks so much for having us today. It's really an honor and pleasure to participate in this webinar. So maybe if we take a look at what is the macro environment and where interest rates are today, we are basically we've been at the zero bound for roughly around 10, 11 years. And given that we've been at this zero bound interest rate environment, one of the challenges that we found with investors globally, particularly for more traditional institutional investors like a pension scheme or an insurance company, is that in order for them to meet their spending or liability needs, they're going to need to either A, move out the risk spectrum, or B, move out the risk spectrum via illiquidity. And we find that because of this phenomenon, institutional investors have shifted more and more of their assets towards alternatives, and particularly within the alternatives income space, whether it's private capital, whether it's real assets, and in particular, real estate as well. And if we look at real estate, it's a asset class that provides a complementary or even more attractive income stream versus traditional fixed income. It's an asset class that could also be a inflationary hedge in some instances. And then number three is that it's less correlated to other asset classes as well. So as a whole, if we look at the conversations that we've been having as a firm globally, alternatives is absolutely front and center, particularly with real estate being at that forefront of the alternatives conversation. Now, same thing with the private wealth side, and I believe that we're going to be getting into that in a little bit more detail as well.
Yes, thank you. Yeah, in terms of private wealth, of course, we would need the petitioners to share a little bit more about how their clients look at real estate right now. Maybe Ray, can you talk about how your clients look at real estate investment right now at the moment?
Sure, thank you. If you ask me that real estate is not something new, I would say it's very traditional alternative investment. So if you look at like Asian market, what we call bricks. I mean, even for the Chinese family, they always think that, okay, we get hold of like something really solid. We can see that it's rather traditional investment, I would say, to be honest. And obviously the needs that they used to have like 10 or like 20 years ago, it's more about the even self-use, like the purpose of buying it, maybe just for my families, like, they want to live in somewhere else, residentially. Second might be just something really strategic to the business point of view, like in the mid to long term, that with my kids or with my family, there needs that commercial building or that kind of cities that they're looking at to build their own business. So I think for family, for office point of view or high net worth point of view, sometimes it's more about like how do we position it as a legacy, like even planning on that. But of course, I mean, on the other hand, it's something that they're looking for diversify from their portfolio. So rather than just some like the business that they're running, the investment from the secondary market, real estate is also like something that they're looking at as a stable income, capital growth. I think that's what we see from the family's office.
Thank you. And Jim, I think you mentioned before that there's quite a lot of overseas holding in terms of your family clients. Can you also share a little bit about how they look at the overseas holdings of their real estate portion right now?
Sure. As a multi-family office, just like base office, in fact, we handle a group of Chinese tycoons as well as Hong Kong tycoons, and then in past 1 to 2 decades, I think most of their wealth is coming from the property investment or property development. And then due to the fact of this wealth accumulation, that's why they are quite keen on the real estate investment. So instead of talking about the whole mainland China and Hong Kong, which we're very familiar with, in fact, they start to try to choose the stage out of China, which is we have already recognized the quick urbanization happening in China, and they try to replicate these kind of models in South Asia, and then of course maybe some traditional Western countries like London and then Australia. They try to do the suburban area. I see my family is trying to do it in this way, in order to scale on the upside of the uptake to the prime cities.
Thank you. That's definitely a trend. I guess we all share the same. So they're looking at more to diversify their portfolio, looking at other cities, and this is how how they look at real estate investment. And in terms of overall trends across the alternative investment books, I think 5 years ago, if we look at our clients, they're more looking at hedge fund, and of course real estate has always been here, but hedge fund 5 years ago is quite popular. And this day, if we look at their book right now, I think they diminished a little bit in terms of hedge fund. And then there's a growing amount of investment they're allocating in private equities. So maybe also, Jim, can you also share a little bit about how your clients look at private equity investment right now?
Sure. Broadly speaking, although every family will deem their investments quite confidential, highly confidential, but I can share it in a broader sense that they deem alternative investment is quite key revenue driven. I mean the capital gain driven in their investment spectrum. In fact, thematic investment, we still see a very key part, play a key role in this area, like impact investing, ESG, and then like some private equity, like some of the digitalization, and then like the new economy. These kind of sectors, we do see our families play a very, very impactful role in these areas.
Thank you. And of course, Ray, I think Raffles have been quite active in terms of deals investment. So can you share a little bit about your thoughts on how's your access to deals and maybe what kind of sectors that you're particularly interested in at the moment?
Right. I think the beauty of really for multi-family office, as well as like how we have like the family office association in Hong Kong, it's actually help a lot of what we can do right now for all like the high net worth individuals, that the demand is huge. First of all, like Jim just mentioned. So I think the first point, like how do we source it? I think it's more about like first, the demand is huge. Secondly, I think it's about like if we have the same thought on what we are looking at, private equities or even like earlier stage investment that can bring to the portfolio itself, or to what the family business has been doing. So there are two ways. One is purely looking at investment, like returns, like how do we look at it. Secondly, I think more importantly is about like what the family or the business has been doing. So what exactly this investment could bring in the value to their current setup, or even like when you pass on like third or even like the fourth generation, that how do you help them to, you know, diversify the risk at the same time that it catching up the whole market. Say after last year pandemic, obviously, like, you know, even for real estate, I assume that could be not the best, you know, because in the past few years, everyone look at TMT, everyone look at like digitalization. For real estate, actually, it's always a cycle, right? So basically, how do we, like, you know, position this in this year and then put it into more middle and long term for the family to tap into this? So I think it's about how we can get the right, you know, access to the deal, as well as expertise that we as a multi-family office on the expert teams, the due diligence procedures that we have, and then we bring in that value to the family. So that's what I think is important to the family. Secondly, I think for if you look at say Hong Kong, Singapore, so it's always a bridge between, like, you know, how like the mainland Chinese investor or even Hong Kong investors that go to, you know, even Southeast Asia. I mean, you guys should be very familiar with this. And then secondly, about like, how do the more mature markets, say the US market or even the European market, that the investor or the families that want to tap into Hong Kong or Singapore to the Asian market. So that's what we think, that from the PE point of view, that they're very, like, you know, they're very smart. The smart money always come to this place, and then you just tap into the right, you know, segment that they want to go into, the right project or like the right deals that they're looking at. Right. So I think that's two points that we think.
Right. And you mentioned access to deals. I think that is also very important. And I think, well, Family Office Association of Hong Kong is definitely a good platform for, I guess, fellow family offices in Hong Kong to work together to find deals that are interesting and helpful for their clients. And you just mentioned the different client appetites in terms of Southeast Asian clients, Hong Kong clients. And can you talk about a little bit more about what's the difference? Is there any demands? They have different demands in terms of investment criteria from client in different sectors.
Yeah, I mean, from if you ask me, Hong Kong has been a very, very, very I mean, even for the past 20 years, right? They're, in terms of capital market, okay, Hong Kong is used always to be like the top three, or even the top in 2019 for fundraising for IPO market in Hong Kong Exchange. So that actually already built up a system or to attracting the private equity investor, or even fund house, that they come to Hong Kong to set their headquarters. So it's already like, you know, you having the parties going on here. I mean, everyone's come here to look for deals. The investor come here to, you know, look for good things. Yeah, on the other hand, like the good companies come to here and to looking for money. Right. So like, I mean, that's has been going on. So in terms of that, I think in Hong Kong, or even for the investor that coming from like here, they would look at like diversification. So rather than just, okay, I know that Asia is a good like market, but what about real estate? What about like what I see in that pandemic, the price dropping, right? So how do we get access to European market, or even like US market? They think that this is a good value right now. Then I think this is more about like diversify to the other the rest of the world. Right. Like from even for Singapore, okay, point of view, if they come to here, they're expecting something that they cannot access, or like they do not have a local team or local expertise to look at it. That's why it's more. I think it's more into the mainland Chinese. I mean, mainland China market. Right. The upcoming trend of like, you know, logistics you just mentioned like in the earlier section. You know, this is something that they have to have Hong Kong as in, like, you know, a stepping stone. That go into the China market, or even the sector they're looking at is more focused on based on the China story. Right. So that's what I think that the big difference is between this two places.
And I think Raffles is doing a very good job in terms of setting up the Singaporean office and also helping the clients to look at deals in the Greater China market.
We still see a great demand from the Southeast Asia, if you see a tycoon, family office, high net worth. They all have a sense that I mean, it's good. The good things over the road is that information is very transparent right now. It takes like a few seconds for information to transfer to everywhere. I mean, so it's easier for them to look into something that they couldn't even imagine to have.
Right.
So what we have right now, like as we mentioned, we have a good association in Hong Kong, even Singapore, that we got good teams that family office exposure in here. It helps a lot of this kind of PE alternative investment going on in the whole Asian market right now.
Right. Thank you. And Henry, because I believe Nuveen is a very good name, very big name in terms of institutional investments. So how to look at your clients, no matter it's institutional or private wealth clients from different regions, say Hong Kong, Greater China, and compared to Southeast Asia or maybe Australia? Do they have different appetites in terms of the investment?
Yeah, absolutely. So maybe I'll start off at the at a very high level and talk about your traditional buyers of real estate, or where they use real estate as a strategic asset allocation, is going to be with institutional investors as they increase that allocation to meet their spending needs, et cetera. Now, what we have found is that on the flip side, you have private wealth investors that have been very much focused on deal making. They're very focused on value add opportunistic if they are in real estate. And then you have the group of private wealth investors that are also looking to increase their alts allocation as well to meet their return expectations. So what we have started to find is that if you look from the perspective of private wealth investors, they are typically looking at a way to replace or maybe just complement their existing fixed income allocation, because this regional world, most clients, when they build a income-oriented portfolio, it's going to be very much tethered to fixed income. So using core real estate or core plus real estate as that really anchor to help complement that income portfolio, but at the same time increasing their exposure to deals or value add, but really by having a strategic asset allocation towards real estate using a core plus anchor, because that's going to be more of an evergreen type of allocation. Your deals will come along. There's going to be certain opportunities. For example, New York City right now, we have a very interesting opportunity where we can build medical office buildings in New York, where there is a very little supply of these types of buildings. So these are the types of opportunities that you can pick up. But unless you are in the real estate game where you are taking exposure via a more, higher quality approach, it's going to be very hard to just jump directly into deals. But I think having these two complementary exposures, typically that's where we've been having a lot of conversations and where we've been finding client interest on.
Thank you. Yeah. And everyone, so feel free to ask and submit your questions through the portal. And then at the end of the panel discussion, we will answer your questions one by one. And thank you for Henry saying that I think deals making is quite an interesting topic and it's very popular among the family offices today. So Jim, can you talk a little bit about how you structure your deals for your clients?
Thank you, Nick. On one hand, families try to preserve their wealth and try to do the succession planning to the second generation, third generation, and so on and so forth. And on this roadmap, at the same time, they also deem the real estate is a very important asset class, especially in this high volatility market. And as we all observe the past years, the equity markets is really volatile, including the fixed income market, the credit crunch, something like that happened last year. So real estate has been quite a sustainable and stable asset class within our family clients spectrum, as we do this point. And then riding on this platform, riding on this asset class, they will have excess amount of cash set aside to pull into the other private equity, as we have mentioned before, like Ray mentioned about the digitalization, so on and so forth. So we see this trend is keep on going, and then we see some more funding out from the hedge funds. So traditional, they do much emphasis on the hedge fund, but for the past decade, hedge fund is not doing particularly well. So in the sense that they try to put some more money. But these alternative classes, I quite agree with Henry that they will keep on insist to paying some more attention towards outside Asia, or maybe New York or Western countries.
And can you share also a little bit about the allocation they have on private equity funds versus private equity deals? What's the preferences right now?
In the meantime, I'll say a proportion like over 70% will invest in private equity, either by direct investment, co-investment, maybe it's a majority stake or minority stake. And private equity fund is around 30%. But this proportion is slightly growing up a bit because they are more likely to get access to more different companies rather than one single project, to take on so much time to study on one single project.
Right.
Yeah.
And Ray, do you share the same thoughts about deals and funds in terms of private equity investment? What do you look at right now?
I absolutely, I agree. Like what Jim just mentioned. I mean, when the market get more mature, the expectation like started having having more expectation, and as well as looking for what we see from here is the mandate that like maybe the family or even the family trust that they have to have quite specific. So the trend would be, we used to go through like more about like say the traditional PE funds established to that, but nowadays they're looking for more co-investment, right? Like for the direct deals that they're looking at. Then again, it's all about like how the families are looking at this sector and what exactly they wanted to put that into their portfolio, as in an alpha driven or more just a strategic partners, strategic point of view that to add on to the traditional business.
Right. Yeah. And I believe this is basically one of the benefits why a family should work with a family office like Raffles and Topaz to help them to get back to access to deals flow, right? And is there any other benefit to, from a family perspective, to work with a family office like Raffles?
Yeah, I mean, PE of course, one of that. And secondly, I think about the we share the same point of view of all the investment selection, the expertise that we can share, the access, of course, like to different opportunities. But I think the key thing here is about when we have a bunch of like people or expertise that have been like working on the same sector, having the same background that like like what we have been doing for our own families. It always saved their time course as well as I think going to be the right thing or right timing. We just have a chat before this, and then it's all about timing. Sometimes it's about like how can you make a decision quick enough or efficient enough to get into the good things. Right. So I think in this world right now, you have to have a good setup. You have to have a good right people or teams that help you to execute things. So I think this is one of the important part from my view.
Thank you. And Jim, what's your view?
Quite similar to what Wade has just said. In fact, besides the economy of scale in terms of expertise, in terms of the deal sourcing process, we do think that as a family office, we do communicate with our family clients. So that's why we know what they need, and then actually clients tend to do business with whom they're familiar with. So that's why in terms of being a bridge in between the vendors or some other investment vehicles or like the private equities deals, we can help them to filters and to source the one that actually you understand that these days deal flow is everywhere. Yes. Simply you have to make sure you do the due diligence, this is a very long process in doing so. So that's why family office can pay this expertise to help our clients, and we understand the clients, and then sometimes clients, even though you understand them, they will sometimes will change or is it in a dynamic mode. So as a family office, we understand clients will have these kind of needs now and then. So that's why in terms of the deal sourcing, we think we can play a very strong role.
Thank you. And there's quite a lot of questions from our attendees. So maybe I brought the questions out and see who would like to take first. So how important is ESG investments to your clients? Maybe Henry, can you share a little
Sure, perhaps I could take a stab at this. So if we look at ESG investing, we would say that this is absolutely at the front and center for many institutional clients, particularly if we were looking at some of the Nordic European countries, where this is a real key criteria. Within our own portfolio, so our parent company TIAA, this is also front and center, and it's been something that has been around for around 50 years. We started off looking at exclusion towards the 1980s. We started to do affordable housing, and then in the early 2000s, we started to look at more formally ESG and joining the UNPRI. So this has always been part of our heritage. And when we look at the trends across North America and Europe, these are the conversations that we've been having. Whereas in Asia, we would say that we're probably at the beginning stages of clients being interested in adopting ESG practices into their portfolios, particularly with second generation wealth. This is where we are starting to see clients care about not just the returns, but where are my returns coming from? What are the impact that it's going to have on society? And so we believe that going forward, these are the conversations that are going to be more and more important. Is this going to be something where they say, okay, I'm going to invest, I'm not going to invest unless it is ESG or impact compliant? I don't think in Asia we're there yet, but I think that at this point in time, people are asking the questions, and if it does meet these criteria, this can only be a positive.
Thank you. And are you seeing similar trends within your clients in terms of ESG?
Yeah, we do share the same similar view as Henry said, because in a shell, to a family, actually the first generation or the patriot matriarch do are concerned about how the world is changing, the climate, the environment. So that's why these gonna be everybody or the humankind will place high attention on. So that's why as a family office, our clients do place much emphasis on this kind of thematic investing in order to on one hand try to do their responsibility issue, on the other hand will be the major trend of our next decade also.
Yeah, I absolutely agree. And just one thing that I add on from our point of view is, besides just looking at like ESG thematic like company, like what we're really doing, we are actually quite confident in like companies that when you look at the deals, or even companies that it's actually show a better return or like more sustainable business if the company have the ESG element in their company. So rather than just, I'm sure that like new renewable energies, right? I mean, things like that is always a good company to invest in. But I think even for some traditional, even we look into like, EV companies that, when they build up the car, what kind of material they use, then actually having an impact on their, future share price, because like it's actually having a positive benefit on that point of view. So if you ask me, that we will be looking into as in like a ESG element in that investment, rather than just looking at the company itself is doing something like so-called like ESG.
Right.
So that's what I think this trend should be like going in that way, as well as like the fact that it's actually having a better return on that.
Right, and I totally agree with you. I used to work with global equity firms, and they have a very strong ESG filters, and not just do it for checking the box. It's really the business making impact to the society, making positive impact. So one of the particular company they look at and they don't like is energy drinks. So energy drink is famous for a lot of sugar content in those drinks, and it is not good for a society, of course. And therefore they give up the opportunity to invest in that company. And it turns out, all we know, UK is basically imposing the sugar tax in those products, and that company actually dropped a lot in terms of their share price. And I think this is a good sample to echo what Ray just said in terms of the business, how business integrate the ESG into their own business, not just the check the box filters. And here is a potential client. They say he said he's high net worth investors, and he's thinking how to reconstruct their portfolio. And what do you think the appropriate asset class allocation, and how much should I put in to alternative, and what should be those alternatives?
Well, that's a good question, but honestly, this is a question that hard to answer right now because we don't understand. I mean, the guy that just asked this question about the background and the culture, or Shawn, maybe just simply a high net worth client, whether about any kind of philosophy he's running on behalf of his family, or later on some succession planning as well. So in generally speaking, we can only say as a statistical wise point of view, we can point out like traditionally we allocate some equity bonds altogether like 40 to 50%, and then to our family office background, our family is trying to place around 1/3 of their allocation in alternative investment, including real estate, including private equity. But I'm not sure. Actually, I'll say I don't think this is a good way to answer the
Yeah, so I think every client is going to be different. Every client's needs are going to be different. And I think it starts off with looking at what is the expected return profile of this client. What is their risk tolerance? What is their liquidity needs? What is the time frame that they're going to be investing in? What are the tax considerations? So I think that in order to answer that question more thoroughly, that's probably the first step to really understand the client's needs before delving further.
Whether the jump directly into the conclusion.
Right. I think that makes
We would love to like share
more.
more.
that makes total sense.
But we were welcome to listen to the client. Yeah.
And I guess a follow-up question for that attendees is, can you share some samples, like maybe first-gen entrepreneurs, second-gen entrepreneurs as your client? Would they have usually what's the difference in terms of expectation and how you construct their portfolio for them?
Generally speaking, maybe you guys.
Yeah, I mean, when I see these kind of questions, I just want to share one thing that I agree with, like what Henry just mentioned about, and before we have this chat, and then if we're facing like the first generation, as I mentioned earlier on in this panel, they're more about because of the traditional thought about having like say real estate as an investment, right? So okay, then I have the feeling that I have to have a family. That's why I have to have a house, from the mansion from mid-level to like in Singapore the shop houses that you see in Chinatown, the colorful one, right? So that's something of a traditional investment for first generation to think about. Okay, this is something I can see, but for second generation, even the upcoming like real tycoons that they derive their assets from like TMT sector, right? Like some internet related like sectors. It might be different because what they think is, yeah, I got a good return, or even like I'm very good at the industry itself, and it's easier to let them know that if we invested into alternative investment, that they might be invested into a data center, like renting out the data center. I mean, it's a good point, right? And or even like telling them that there's actually renting to a warehouse, which is the logistic company they're going to rent. So I think the point of view that the investor looking at from the first generation and second generation, or even like for those high net worth, like coming up high net worth, that it's quite different. Like even it's totally different, to be honest. So what they need right now and what they're looking at right now is more from their what they have been successful from their point of view. So what we as a professional teams, like family offices can do for them, like even a Nuveen fund house for them, is really to get up to the trend, up to the market, and to serve. That's what the purpose that they need. So I mean, this is one of the points that I think is quite important.
Thank you.
Sorry, maybe I can add on just one or two more points on that is if you look at the composition of real estate, it's also changing as well. Traditionally, if you are building a real estate portfolio, you typically would have retail, you would have office, you would have multifamily, you have industrial, and that would be 99% of what you would hold on to. Today, markets are changing, and because of the tech boom, because of the move towards e-commerce, because of the move towards Sunbelt cities, we're starting to see the rise of alternatives within real estate. So not alternatives as an asset class, but alternative real estate segments. So whether it's data centers, whether it's single family homes, whether it's cell towers, and these are areas where we would estimate that over the next 10 years, this could go up to around 50% of a core real estate allocation. So it's definitely something to watch. And so when we talk about first gen and second gen, yes, maybe real estate is a suitable asset class for them, but the composition of it is going to be very different from what they've invested in yesterday versus what they're going to be investing in today.
Yeah. Maybe I can also add just 1 to 2 points here.
Sure.
Traditionally, especially to the Chinese tycoons, there's a Chinese saying that from shirt sleeves to shirt sleeves. That's why they have to really set their investment objective or goals to preserve their wealth to the next generation, so on and so forth. But this is kind of a misconception, honestly, when we come across with our families. We do see that for the first generation, I mean the principal, they build up their business, their operating business from scratch. So they're always more likely to take risks, in fact. So that's why we see private equity, they are more likely to drive even the second generation, take hands in hand to join these projects. So second generation has a very good inclination to try on new things, digitalization, but at the same time, they might not have the ability or the undertaking to hold the whole family's investment. But the first generation, we do see that they give much room for the second generation to get involved in this private equity project with there as well. So that's why we do see there's a trend that even this real estate project sometimes will last for, say, at least 5 years or sometimes 10 years, if not. As a family office basis kind, they will have this kind of tendency to invest in such a rather long time horizon project in order to reap the high profit.
Thank you. And there's a follow-up question for Henry. So in the past 10 years, Hong Kong's real estate price has gone up a lot, both residential and commercial. And if you were to advise a client, a high net worth client, about real estate allocation, how would you think about real estate in Hong Kong compared to other Asian cities like Taipei and Tokyo?
Okay, so if we look at our investments currently, we actually don't have a lot of investments in Hong Kong. We actually are more focused on some of the other regions across Asia Pacific. So for example, Tokyo, we have exposure to Tokyo multifamily housing. In Japan, more specifically, we have industrial warehouses. In Seoul, we also have industrial warehouses where we're trying to play on the fact that there is a shift from physical retail towards e-commerce. So that's one of the trends that we've been seeing. So rather than look at how do we get access to Hong Kong multifamily, where arguably you could say, is it overvalued or fully valued, but at least from our standpoint, we think that there is probably better value or relative value if you're looking at the industrial segment or other regions in Asia. Now, if we look more collectively at Asia versus other regions, we see that the U.S. still provides a little bit better relative value at this moment in time. And so even though we have portfolios that are global in nature that can allocate to Asia, we're not seeing these allocations go completely towards Asia yet, because at the moment we still see a better relative value in the shorter to medium term. Now, over the longer term, we do believe that Asia is going to present better valuations, and so these allocations will start to trend upwards over time. So we believe that by picking our spots right now opportunistically, and then from there increasing that overall allocation, that would be at least the way that we would be approaching Asia at the moment.
Thank you. And there's one more question, and I think that question should be for Ray and Jim. So I'm a single family office, and how can I benefit from working with the Family Office Association of Hong Kong?
Yeah, sure. I mean, this is a very good questions. I think since last year we were very proud to be the co-founding members of the Hong Kong Family Office Association. First, I think it's very important industry for Hong Kong to really. I mean, Hong Kong always has been a good place for family to set up their own family office here. To source a good deal, to have a good professional team, as well as I think the Hong Kong government having good support on the policy side as well. We all understand that they're helping a lot on setting up the association itself. So within the panel, we already mentioned about if we are a group of family office in Hong Kong that we're getting together, we should be able to at least to share what we have, the information on hand on the very beginning on even for the investment side. That's first. Secondly, I think it's more about the sharing and then the experience that we have as a whole association, that we always fight for the best for all the high net worth individuals, also as well as the family office in Hong Kong, not just Hong Kong. I mean, we if you ask me, that we are actually welcoming not just the family office in Hong Kong or single high net worth in Hong Kong, as well as the foreign investor coming to Hong Kong. We're more than welcome to them to group together in an association that we can help them out. So and that's the key point of the association on that.
Yeah, I agree with Ray, and that's perhaps the most important of all of our original mindset to help set up this FOHK in Hong Kong, and also echoing the voice of the Hong Kong SAR to promote Hong Kong as the Asian family office hub. And in a sense that we do this way, and besides what we had just shared with you all, in fact, we also would deem this as a platform to get more tenants in terms of all the expertise, and then as well as not only serving Hong Kong or in China tycoons, but also some other regional or even worldwide international family office together to come to Hong Kong. And then in that sense, we can learn from different family office experience and backgrounds, and then that will make Hong Kong's international financial hub as well as the family office center even better.
Thank you. So I guess I would suggest to that particular attendees to join the association as soon as possible. And I think that is all the questions we have. So thank you for everyone's time. Thank you for all of your time.
Thank you. Thank you.
Thank you. And feel free to send us any question afterwards if there is any.